Hi, my name is Anna Hess, your Patton University course instructor for Financial Institutions and Markets. Let's start with the introduction. The global financial system affects everyone in the world, whether they realize it or not. If you keep your money in a bank, use a credit card, or have taken out a loan to buy a house, car, or other large item, then you interacted with the financial system every day. Beyond that, some people make trades in the stock market or keep money for retirement in mutual funds. Even if you don't keep your money in a formal banking institution, the actions of these institutions can affect the price of products and wages earned for your work. So you are still affected by the financial system. And if you plan to work within the business sector, then the actions of the financial system will have a dramatic effect on your work. In this unit, you'll gain the foundation needed to navigate the world of financial institutions and markets. You'll review the roles and functions of key institutions and markets, as well as gain perspective on how assets and information travel through the markets and keep them running. Objective 1. Define the functions of financial institutions and markets. Let's start with the reading. Chapter 1. An Introduction to Money and the Financial System. This morning, a typical American college student bought coffee at a local cafe, paying for it with an ATM card. Then she jumped into her insured card and drove to the university, which she attends thanks to her student loan. She may have left her parents' home, which is mortgaged, a few minutes early to avoid construction work on a new dormitory, financed by bonds issued by the university. Or perhaps she needed to purchase this book online, using her credit card before her money and banking class began. Beneath the surface, the financial transactions embedded in this story, even the seemingly simple ones, are quite complicated. If the cafe owner and the student use different banks, paying for the coffee will require an interbank funds transfer. The company that insures the student's car has to invest the premiums she pays until they are needed to pay off claims. The student's parents almost surely obtained their home mortgage through a mortgage broker, whose job was to find the cheapest mortgage available. And the bonds the university issued to finance construction of the new dormitory were created with the aid of an investment bank. This brief example hints at the complex web of interdependent institutions and markets that is the foundation for our daily financial transactions. The system is so efficient that most of us rarely take note of it. But a financial system is like air to our economy. If it disappeared, suddenly everything would grind to a halt. In the autumn of 2008, we came closer to such a financial meltdown than at any time since 1930s. In the earlier episode, the collapse of the banking system led to the Great Depression. In the recent crisis, some of the world's largest financial institutions failed. Key markets stopped functioning, credit cards dried up, even for sound borrowers. As a result, vibrant companies that relied on short-term loans to pay their employees and buy materials faced potential ruin. Even some fundamental ways that we make payments for goods and services were threatened. Gasping for air in this financial crisis, the global economy during 2008 and 2009 sank into the deepest, broadest, and longest downturn since the 1930s. Around the world, tens of millions of people lost their jobs. In the United States, millions lost their home and their life savings. Others became unable to borrow, to buy a home, or to go to college. And the weakness added to the financial fragility elsewhere, especially in Europe, where the viability of the euro, the world's leading currency after the US dollar, was threatened. The chances are so good that you know someone in your neighborhood, your school, or your family whose life was changed for the worse by the crisis. So what happens in the financial system, whether for good or bad, matters greatly for all of us. To understand the system, both its strength and its vulnerabilities, let's take a closer look. The 6 parts of the financial system. The financial system has 6 parts, each of which plays a fundamental role in our economy. Those parts are money, financial instruments, financial markets, financial institutions, government regulatory agencies, and central banks. We use the first part of the system, money, to pay for our purchases and to store our wealth. We use the second part, financial instruments, to transfer resources from savers to investors and to transfer risk to those who are best equipped to bear it. Stocks, mortgages, and insurance policies are examples of financial instruments. The third part of our financial system, financial markets, allows us to buy and sell financial instruments quickly and cheaply. The New York Stock Exchange is an example of a financial market. Financial institutions, the fourth part of the financial system, provide a myriad of services, including access to the financial markets and collection of the information about prospective borrowers to ensure that they are all creditworthy. Banks, security firms, and insurance companies are examples of financial institutions. Government regulatory agencies from the fifth part of the financial system. They are responsible for making sure that the elements of a financial system, including its instruments, markets, and institutions, operate in a safe and reliable manner. Finally, central banks, the sixth part of the system, monitor and stabilize the economy. The Federal Reserve System is the central bank of the United States. While the essential functions that define these six categories endure, their form is constantly evolving. Money once consisted of gold and silver coins. These were eventually replaced by paper currency, which today is being eclipsed by electronic funds transfers. Methods of accessing means of payment have changed dramatically as well. As recently as 1970, people customarily obtained currency from bank tellers when they cashed their paychecks or withdrew their savings from the local bank. Today, they can get cash from practically any ATM anywhere in the world. To pay their bills, people once wrote checks and put them in the mail, and then waited for their monthly bank statement to make sure that the transactions had been processed correctly. Today, payments can be made automatically, and account holders can check the transactions at any time in their bank's website or on their smartphone. Financial instruments, or securities as they are often called, have evolved just as much as currency. And in the last few centuries, investors could buy individual stocks through stockbrokers, but the transactions were costly. Furthermore, putting together a portfolio of even a small number of stocks and bonds was extremely time-consuming. Just collecting the information necessary to evaluate a potential investment was a daunting task. As a result, investing was an activity reserved for the wealthy. Today, financial institutions offer people with as little as $1,000 to invest the ability to purchase shares in mutual funds, which pool the savings of a large number of investors. Because of their size, mutual funds can construct portfolios of hundreds or even thousands of different stockers and/or brokers. The markets where stocks and bonds are sold have undergone a similar transformation. Originally, financial markets were located in coffee houses and taverns where individuals met to exchange financial instruments. The next step was to create organized markets, like the New York Stock Exchange, trading places specifically dedicated to the buying and selling of stocks and bonds. Today, most of the activity that once occurred at these big city financial exchanges is handled by electronic networks. Buyers and sellers obtain price information and initiate transactions from their desktop computers or from handheld devices. Because electronic networks have reduced the cost of processing final transactions, even small investors can afford to participate in them. Just as important, today, financial markets offer a much broader array of financial instruments than those available even 50 years ago. Financial institutions have changed as well. Banks began as vaults where people could store their valuables. Gradually, they developed into institutions that accepted deposits and made loans. For hundreds of years, in fact, that was what bankers did. Today, a bank is more like a financial supermarket. Walk in and you'll discover a huge assortment of financial products and services for sale, from access to the financial markets to insurance policies, mortgages, consumer credit, and even investment advice. The activity of the government regulatory agencies and the designs of regulation have been evolving and have entered a period of more rapid change too. In the aftermath of the financial crisis of 1929 to 1933, when the failure of thousands of banks led to the Great Depression, the U.S. government introduced regulatory agencies to provide wide-ranging financial regulation, rules for the operation of financial institutions and markets and supervision, oversight through the examination and enforcement. The U.S. agencies established in the 1930s to issue and enforce these financial rules still operate. Yet, the evolution of financial instruments, institutions, and markets has led to many changes in the ways that regulatory agencies work. A bank examiner used to count the money in cash drawers and called borrowers to see if the loans on a bank's book were real. The examiner might visit workplaces to see if the loans were used as designed to buy equipment or build a factory. Today, banks engage in millions of transactions, many of which are far more complex and difficult to understand than a loan or a mortgage. So a government examiner also looks at the systems that a bank uses to manage its various risks. In doing so, regulators try to encourage best practices through the financial industry. However, the failure of regulators in the United States and elsewhere around the world to anticipate or prevent the financial crisis of 2007 to 2009 has led many governments to undertake far-reaching changes to financial regulation and regulatory agencies. The Dodd-Frank Wall Street Reform and Consumer Protection Act, adopted in 2010 and known as the Dodd-Frank Act, is the largest U.S. regulatory change since the 1930s. Also in 2010, regulators of many nations agreed on a third major update of standards for internationally active banks, known as Basel III. After the Swiss city where the policymakers meet, both reforms will take years to implement, and their influence will shape financial systems for decades. Okay, finish reading this on your own. Okay, after the reading, you'll see that there's an external page called Components of Financial Systems that you should do. There's then an external page called Types of Financial Markets and Their Roles that you should read. And then there's an activity of flashcards so that you can review. Okay, moving on to Objective 2. Let's read Money and the Payment System together. The makers of the board game Monopoly print on average about $50 billion of Monopoly money every year, coincidentally about the same as the amount of new U.S. currency, excluding $100 bills, issued in 2010. Every new game has bills totaling 20,580 Monopoly dollars. At a cost of about $18 US per set, this money would be a good deal if you could buy things other than Boardwalk and Park Place with it. Unfortunately, attempts to pay for groceries, books, or rent with this particular form of money have been unsuccessful, and that's probably a good thing. Since the mid-1930s, Parker Brothers have sold more than 250 million Monopoly games, containing more than 4 trillion Monopoly dollars. When we pay for our purchases in the real world, we have lots of choices. Crisp new $20 bills, credit cards, debit cards, checks, or more complicated electronic methods. Regardless of the choice we make, we are using money to buy our food and clothes and pay our bills. To make sure we can do it, thousands of people work through the night for the payment system never really sleeps. And the volume of payment is astounding. The Federal Reserve reports that in 2012, there were 122 billion non-cash payments made in the United States, 18% of which were paper checks. That means something like 88 million paper checks and 400 million electronic payments were processed on an average business day. And regardless of how you choose to pay, the path that the payment follows is pretty complicated. To understand why money is so important to the smooth functioning of the economy and how it improves everyone's well-being, we need to understand exactly what money is. Just why is a $20 bill issued by the U.S. government much more useful than a $20 bill in Monopoly money? Furthermore, to quantify the impact of money on the company, we need to be able to measure it. Those are the goals of this chapter, to understand what money is, how we use it, and how we measure it. Money and how we use it. When people use the word money in conversation, they mean many different things. Someone who makes lots of money has a high income. A person who has lots of money is wealthy. We will use the word money in a narrow, specialized sense to mean anything that can readily be used to make economic transactions. Formally defined, money is an asset that is generally accepted as payment for goods and services or repayment of debt. Income, in contrast, is a flow of earnings over time. Wealth is the value of assets minus liabilities. Money is one of those assets, albeit a very minor one. Money, in the sense we are talking about, has 3 characteristics. It is 1, a means of payment, 2, a unit of account, and 3, a store of value. The first of these characteristics is the most important. Anything that is used as a means of payment must be a store of value and thus is very likely to become a unit of account. Let's see why this is so. The primary use of money is as a means of payment. Most people insist on payment in money at the time a good or service is supplied because the alternatives just don't work very well. Barter, in which a good or service is exchanged directly for another good or service, requires that a plumber who needs food find a grocer who needs plumbing repair. Relying on this double coincidence of wants surely causes the economy to run less smoothly. The plumber could pay for his breakfast cereal with a promise of plumbing services, which the grocer then could transfer to someone else. But while it would be possible to certify the plumber's trustworthiness, taking payment in money is easier. Money finalizes payments so that buyers and sellers have no further claim on each other. That is money's special role. In fact, so long as a buyer has money, there is nothing more the seller needs to know. As economies have become more complex and physically dispersed, reducing the likelihood that a seller will have good information about a buyer, the need for money has grown. The increase in both the number of transactions and the number of potential buyers and sellers, the vast majority of whom may never see one another, argues for something that makes payment final and whose value is easily verified. That something is money. A unit of account. Just as we measure length using feet and inches, we measure value using dollars and cents. Money is the unit of account that we use to quote prices and record debt. We could also refer to it as a standard of value. Your financial world. Debit card versus credit cards. When you go shopping, you should pay with a credit card. When you go shopping, should you pay with a credit card or a debit card? To decide, you need to understand the difference between the two. First, make sure you know which of your cards is which. Usually an ATM card, the one that you got from the bank where you opened your checking account, is a debit card. But check to make sure. What's the real difference from the shopper's point of view? A debit card works just like a check, only faster. When you write a paper check, it usually takes a day or two to go through the system. A debit card transaction goes through right away. The electronic message gets your bank on the same day, and your account is debited immediately. So if you want to use your debit card, your account balance has to be higher than the payment you want to make. During and after the financial crisis that began in 2007, debit cards sharply outpaced credit card activity, as lenders and borrowers sought to slow the expansion or even reduce the outstanding level of household debt. A credit card creates a deferred payment. The issuer agrees to make the payment for you, and you repay the debt later. That sounds good, but there's a catch. If you're late paying, there's a late fee. And if you don't pay the entire debt every month, you pay interest on the balance, in what is usually a very high interest rate. If you do pay your entire credit card debt every month, however, there is no late fee and no interest charge. Hence, you get an interest-free loan from the time you make purchase to the time you pay your balance. If you can pay off your credit cards in full and on time, it is to your advantage to use them. Credit cards have another advantage over debit cards. They help you build a credit history, which you'll need when the time comes to buy a car or a house. Because debit cards are just extensions of your bank account, they don't show potential lenders that you are creditworthy. In fact, some businesses, like car rental companies, require their customers to use credit cards for this reason. Having a unit of account is an incredible convenience. Remember from microeconomics that prices provide the information consumers and producers use to ensure that resources are allocated to their best uses. What matters are the relative prices of goods and services. When the price of one product is higher than the price of another, that product is worth more to both producers and consumers. Using dollars makes these comparisons easy. Imagine what would happen if we needed to compute relative prices for each pair of goods. With 2 goods, we would only need 1 price. With 3 goods, we would need 3 prices. But with 100 goods, we would need 4,950 prices. And with 10,000 goods, substantially less than the 42,000 products in a typical supermarket, we would need nearly 50 million prices. Using money as a yardstick and quoting all prices in dollars is certainly easier. Store of value. For money to function as a means of payment, it has to be a store of value too. That is, if we are going to use money to pay for goods and services, then it must retain its worth from day to day. Sellers are much less likely to accept things that are perishable, like milk or lettuce. So the means of payment has to be durable and capable of transferring purchases power from one day to the next. Paper currency does degrade with use. $1 bills have an estimated lifespan of 70 months in circulation. But regardless of its physical condition, it is usually accepted at face value in transactions. Of course, money is not the only store of value. We hold our wealth in lots of other forms: stocks, bonds, houses, even cars. Many of these are actually preferable to money as stores of value. Some, like bonds, pay higher interest rates than money. Others, like stocks, offer potential for appreciation in nominal value, which money does not. Still others, like houses, deliver other services over time. Yet we all hold money because money is liquid. Liquidity is a measure of the ease with which an asset can be turned into a means of payment, namely money. For example, a bond is much more liquid than a house because it is so much easier and cheaper to sell. The more costly it is to convert an asset into money, the less liquid it is. Because constantly transforming assets into money every time we wish to make a purchase would be extremely costly. We keep some money around. Financial institutions often use a more specific term, market liquidity, for their ability to sell assets for money. A second related concept, funding liquidity, refers to their ability to borrow money to buy securities or make loans. For financial institutions, liquidity in both senses is critical to their daily operations. A shortfall of either type can be led to their outright failure. See lessons from crisis, market liquidity, finding liquidity, and making markets on page 32. Read the rest on your own. After finishing this reading, you'll want to read the external page called The Impacts of Different Financial Assets, and then the external page, Payments Systems Issued. And then there's another reading called Practice Activity, The Role of Money. And lastly, there are flashcards to review. Okay, we're now going to read Unit 3, Financial Instruments, Financial Markets, and Financial Institutions. Long before formal financial institutions and instruments became common, there were times when people lacked the resources to meet their immediate needs. In the terminology of introductory economics, people's incomes were exceeded by their necessary consumptions. When a harvest was poor, they would dip into the reserves stored from previous years or exchange assets like land and livestock for food. But often these measures were insufficient. So communities developed informal financial arrangements that allowed people to borrow or lend money among themselves. After a poor harvest, those people with relatively good yields would help those with relatively poor yields. When the tables were turned, help flowed the other way. In some societies, families spread out geographically to facilitate these arrangements. For example, in rural Indian communities, households deliberately married off their daughters to families in different regions to increase the chance that their in-laws would be able to respond in a time of crisis. These informal insurance arrangements ensured that everyone had enough to eat. While family members and friends still made loans among themselves, the information arrangements that were the mainstay of the financial system centuries ago have given way to the formal financial instruments of the modern world. Today, the international financial system exists to facilitate the design, sale, and exchange of a broad set of contracts with a very specific set of characteristics. In recent decades, finance has evolved at an unprecedented pace, and our understanding of it has changed too. Formerly, economists distinguished sharply between direct finance, in which a borrower sells a security directly to a lender, and indirect finance, in which an institution, like a bank, stands between the lender and the borrower. If we need a loan to buy a car, we usually get it from the bank or a finance company. That's a classic example of indirect finance. Once we get the loan, the car becomes one of our assets, and the loan becomes our liability. We all have assets and liability. Your assets probably include things of value like a bank account or a computer. If you have a student loan or credit card debt, those are among your liabilities. In contrast, if you borrowed directly from your parents or a friend, that would be an instance of direct finance. They own the asset, the loan, and you are obliged to pay them, rather than a bank directly. As finance grows increasingly sophisticated and complex, virtually all transactions take on some indirect flavor. Today, even direct finance usually involves a financial institution or intermediary in some fashion. When a lender purchases a security issued by a specific firm or government, the transaction particularly takes place through a security broker or an investment bank that helps the issuer distribute new stock or bonds. These securities become assets for the lenders who buy them and liabilities for the government or corporation that created them to obtain funds. Frequently, the lenders are themselves intermediaries, such as mutual funds that gather and hold such security for their investors. Reflecting this trend towards institutionalization, the only lingering distinction between direct and indirect finance is who owns the underlying asset. Under direct finance, the asset holder has a direct claim on the borrower. In the case of the indirect finance, the asset holder owns a claim on a financial institution, like a bank or a mutual fund, that in turn owns a claim on the borrower. Put differently, the historical gap between the two forms of finance has narrowed sharply over decades. Whether a modern financial transaction is direct or indirect, intermediaries are usually heavily involved. As we will see later in this chapter, especially in chapters 11 through 14, the job of the intermediaries is to produce and use the information that makes modern finance effective. As a result, users and providers of funds can better satisfy their needs, and economies can expand. The financial system channels funds from lenders to borrowers through intermediaries. In indirect finance, a financial institution, like a bank, takes the resources from lender in the form of a deposit, or something like that, and then provides them to the borrower in the form of a loan, or the equivalent. Even in the case of direct finance, where the saver acquires a direct claim on the user of the funds, a financial institution, like a stockbroker or an investment bank, is usually involved in the transaction. Indeed, such financial development is inextricably linked to economic growth. A country's financial system has to expand as its level of economy activity rises, or the country will stagnate. The role of the financial system is to facilitate production, employment, and consumption. In a prosperous economy, people have the means to pay for things and resources to flow for their most efficient uses. Savings are funneled through the system so that they can finance investment and allow the economy to grow. The decisions made by the people who do the saving direct the investment. In this chapter, we will survey the financial system in 3 steps. First, we'll study financial instruments, or securities, as they are often called. Stocks, bonds, and loans of all types are financial instruments, as are more exotic agreements like options and insurance. Exactly what are these financial instruments and what are their role in the economy? Second, we'll look at financial markets, such as the New York Stock Exchange and the NASDAQ, National Association of Securities Dealers Automatic Quotations, where investors can buy and sell stocks, bonds, and various other instruments. And finally, we'll look at financial institutions, what they are and what they do. Financial instruments. A financial instrument is the written legal obligation of one party to transfer something of value, usually money, to go to another party at some future date under specified conditions. Let's dissect the definition to understand it better. First, a financial instrument is a written legal obligation that is supplied to government enforcement. That is, a person can be compelled to take the action specifically in the agreement. The enforceability of the obligation is an important feature of financial instrument. Without enforcement of the specified terms, financial instruments would not exist. Second, a financial instrument obligates one party to transfer something of value, usually money, to another party. By party, we mean a person, company, or government. Usually, the financial instrument specifies that payments will be made. For example, if you get a car loan, you are obliged to make monthly payments of a particular amount to the lender. And if you have an accident, your insurance company is obliged to fix your car, though the cost of the repair is left unspecified. Third, a financial instrument specifies that a payment will be made at some future date. In some cases, such as a car loan that requires payments, the dates may be very specific. In others, such as car insurance, the payment is triggered when something specific happens, like an accident. Finally, the financial instrument specifies conditions under which a payment will be made. Some agreements specify payments only when certain events happen. That is clearly the case with car insurance and with stocks as well. The holder of a stock owns a small part of a firm and so can expect to receive occasional cash payments called dividends when the company is profitable. There is no way to know in advance, however, when such payments will be made. In general, financial instruments specify a number of possible contingencies under which one party is required to make a payment to another. Uses of financial instruments. Stocks, loans, and insurance are all examples of financial instruments. Taking them as a group, we can see that they have three functions. See Table 3.1. Financial instruments can act as a means of payment, and they can also be stores of value. Thus, they offer two of the three uses of money. Remember from Chapter 2 that money is a means of payment, a unit of account, and a store of value. But financial instruments have a third function that can make them very different from the money. They allow for the transfer of risk. Recall that a means of payment is something that is generally accepted as a payment for goods and services or repayment of a debt. It is possible to pay for purchases with financial instruments, even if they don't look much like money. An example is the willingness of employees to accept a company's stock as payment for working. This means of payment was very popular in the late 1990s, when the stock market was booming. While we cannot yet pay for groceries with our shares of stock, the time may come when we can. For now, although some financial instruments may function as a means of payment, they aren't terribly good ones. Having a store of value means that your consumption doesn't need to exactly match your income. For days, months, and years, if necessary, you can spend more than you make, repaying the difference later. Even though most of us are paid weekly or monthly, we eat every day. As stores of value, financial instruments like stocks and bonds are thought to be better than money. Over time, they generate increase in wealth that on average exceed those we can obtain from holding money in most of its forms. These higher payoffs are compensation for higher levels of risk, because the payoff from holding most financial instruments are generally more uncertain than those that arise from holding money. Nevertheless, many financial instruments can be used to transfer purchasing power into the future. The third use of a financial instrument lies in its ability to transfer risk between the buyer and the seller. Most financial instruments involve some sort of risk transfer. For example, think of wheat farmers. If only one farm has a huge harvest, that farmer does really well. But if everyone's harvest is huge, the prices can plummet and individual farms can lose money. The risk that the harvest will be too good, resulting in low grain prices, is a result that most individual farmers do not want to take. A wheat futures contract allows the farmer to transfer that risk to someone else. A wheat futures contract is a financial agreement in which two parties agree to exchange a fixed quantity of wheat on a prearranged future date at a specified price. By fixing the price at which the crop will be sold well in advance of the harvest, the farmer can forget what happens in the wheat market because the risk has been transferred to someone else. Okay, you should finish reading this on your own. Okay, there's now an external page called Wall Street's Twitter Jitter Proves the Efficient Markets Hypothesis Correct that you should read. There's an external page called Budget, Transparency, and Financial Markets that you should read. There's another reading called Practice Activity, What Would You Do? And then there's flashcards. This concludes Unit 1.